Good afternoon, everyone. I, Anju, on behalf of NEN and Wadhwani Foundation, would like to invite you all for this webinar and also introduce our expert. Mr. Ashwin Raghuraman, he is an early stage fund manager and startup advisor. Most recently, he was the Chief Operating Officer, India Innovation Fund, an early stage venture capital fund promoted by NASSCOM and supporting innovative startups in the ICT and life science sectors. A founding member of the fund, Ashwin led investments into startups and represented the India Innovation Fund on the boards of multiple portfolio companies. He is additionally the independent director on the boards of other startup firms. Apart from driving this flagship program of India Innovation Fund, Ashwin earlier headed the innovation initiative at NASSCOM with the mandate to increase innovation in the Indian IT industry. He is a speaker and an evaluator at several entrepreneur events and business plan competitions and has been a mentor and guide to several entrepreneurs. Before I hand over the floor to Mr. Raghuraman, here are a few reminders for the audience. You will all be on mute and you may ask questions by typing in the panel provided. Mr. Raghuraman, you can start off the presentation and I will be changing the slides from here. Thank you.
Sure, thanks, Anju. Am I audible?
Yes, you are.
Yeah, okay. Hi, everyone. Good afternoon, and sorry for the slightly delayed start because of some technical issues. Hopefully, I'm coming through loud and clear. Feel free to point out to Anju in case you think I'm a little too fast or not very audible, right? The other thing is, given the sort of mystery behind who is part of this webinar and the audience, what I have done as part of this is to raise the basic questions, and I'll talk through in this presentation some of the very basic concepts behind going out and when you go out to raise your first investment round. And feel free after the presentation to come back with a little bit more pointed questions and greater depth of answers in case you think that this was a little too basic, right? I'll probably try and wrap up the presentation in about 20-25 minutes and then leave the rest of the time for the Q&A, right? And hopefully there will be more questions than just this presentation that I'm going to make. Right, so Anju, if you can just move to the first slide, or the second slide, which is the basics: when, who, and how much, right?
Sure.
That's the first question that entrepreneurs. Sorry, I'm just getting some feedback, Anju. Is that somebody on the line?
Mr. Raghuraman, I think there was some issue there. So are you able to hear me properly now?
Yeah, it's fine. And I think the disturbance is gone. So shall I continue?
Yes, you can. I'm on the first slide which says the basics: when, who, and how much.
Yeah. So I think these are the first sort of questions that any entrepreneur asks as they move from ideation and as they move ahead in their entrepreneurial venture. And the important thing to know is who to approach at what point in time so that you get the sort of answers that are relevant to you, as well as not waste your time perhaps approaching the wrong segment of people who may not invest at you at a particular point in your evolution. So the key to understand here that from an investment standpoint, the entrepreneurial journey of a startup moves through several phases, and at every phase in your journey there is a different investor who is going to possibly hold the baton, and once that phase completes and you hopefully move on to the next phase, that baton gets handed over to another type of investor, another nature of investor. And so I'm going to actually go back to even pre-VC, because that's where a lot of entrepreneurs are. People with ideas or building prototypes or in the process of having just completed building a prototype and starting to test the market, right? And broadly, and I'm generalizing here when I say that when you're in the idea to prototype stage, you will ideally try and approach angel investors or incubators. You could go to some of the accelerators, and there are also government funds which are available. A lot of allocation was made in the recent budget as well. And, it is between idea and prototype, you are better off not going to a venture capital fund because chances are that your answer would be, or the answer that you would get is to come back later, right? And I would, when I'm approaching an angel investor, try to identify somebody who either knows me and is investing in me more than my idea, because ideas are dime a dozen. The only thing that people can evaluate at that early stage is the quality of the team. And who better than somebody in your circle or somebody that you worked for before or somebody that you know. Of course, today there are a bunch of angel investment forums, right, which include some of the networks which have come up and which are investing at a fairly seed stage in a startup. And the good or the way you approach these is to actually try and find an angel champion, somebody who understands your business. So if you're trying to do something in the hospitality industry, perhaps you should be trying to find an angel who has been part of the hospitality industry and who is willing to champion your cause within a larger community of angels or within angel networks itself. The other part of it is incubators, and incubators are fairly focused on certain sectors. So, and that goes for accelerators as well. And therefore, try and find something that fits in terms of their mandate or thesis with what you are attempting as a startup. As you evolve, and typically this is where VC funds will come in, is when you have established product market fit, which means that you have understood to a certain extent your business model, broadly, at least at a basic level. You put your product out in the market and customers have accepted it. They're willing to pay a price point that you have, perhaps you have gone through a price discovery process, but you basically understood the moving parts of your business, who could be your customers, etc. You've got a model which is working and which is monetizable, and you can demonstrate to the venture capital community, right? And this is typically when you would go in for a seed or a Series A type investment to a venture capital fund, who would then, if they like your idea, look at it more seriously than if you were to go at an idea stage or a prototype building stage. Of course, there are, exceptions to the rule. For example, if you are building a high value medical device, or you are in the biotech space, which has a lot of capital that is required even at the development stage, the chances are that you could go to a venture capital fund even during your product development and raise some amount of small money if you are able to show credibility and if you're able to show a concept which is or noteworthy, right? The third part is once you've gone past the early stage venture capital, I think things become easier in the sense that you already have an investor to guide you and to help you to raise your further rounds of funding. We will see, of course, the valley of death, as they call it, which often happens after your first stages of funding, and we'll talk about that a little later in this presentation. But your next part will be your growth capital and your scale-up capital, right? Which is, once you've established your model, then you're really trying to invest in scaling it up, reaching out to as many consumers as possible. The model has been established, price points have been discovered. Broadly, you understood your customer, and you're now trying to move to reaching a very large set of customers, right? And if I were to take an example here, just think through somebody like Lenskart, who might have set up around 2010-11 timeframe. It took a couple of years to really get going, establish their model, started setting up some franchisee stores as well on the ground and not just a web portal. And then once they've done all of that, they've gone out and raised a lot more capital, and then you see them now on TV advertisements, or you've seen them in the last year and a half at least on TV advertisements, right? And that's the stage at which they've taken in growth capital to really reach out to a very broad audience and spend money on acquiring customers. So that is when you'll actually go for growth capital. Next question, very important, how much do you try and raise, right? And it is important because when you go and you make the ask, you should be very clear as to whether you want a smaller amount or a higher amount. And there's no real correct answer for this, except there's two ways to approach the question. One is there's a typical thumb of rule that says that you need to, or you should try and raise enough capital to take you for the next 18 months, assuming your sales don't work out the way you plan them to, because they never happen, right? All my experiences with every single startup I've either invested in or been on the board of, nobody has ever met their sales targets in the way they planned them to be. So a good thumb rule there is 18 months of capital. And the other way to look at it, right, is really when are you going to be able to raise your next round, right? And that will be, for example, if you're moving from having a basic prototype to, and you need money to test this out in the market with perhaps beta customers, what will it take for you? And maybe you need a certification as well, right? What capital will it take for you to be able to prove that your model works, so that by the time you hit, let's say, an early stage venture capital fund, you have sufficient capital to take you to that next level. And just remember that when you're in conversations with venture capital funds, you will spend time. It's not like those discussions happen overnight and that the investor will really just sign a check overnight. It's going to take time. It's going to take enough of a process, and you should budget for anything between 3 to 4 months for actually allowing the venture capital process itself to go through after venture capital fund has even some interest in your startup, right? Coming to the graphic at the bottom, we'll talk about this more a little bit later as to who, and when I say who now, if you're approaching the venture capital community or the angel community, who are you really going to, target? And there are two strategies here, one of which is to say that success breeds success, which is really, winning is a habit. And therefore, you don't just approach anybody and everybody, and you're very select with who you approach. And the other way to go about it is to just say that, let me target everybody out there who is an investor and just take my chances with life. So these are two different philosophical approaches, and later in the presentation, I'll just talk through this a little bit more. Anju, can you just move on to the next slide?
Sure, Mr.
Elements of a startup.
Sure, yeah. So we are on the slide, elements of a startup, what sets you apart?
Yeah, thanks. So when investors look at startups, right, startups, there are broadly three predominant things. And you can add to this list, there are any tertiary items as well. But there are three fundamental things that we would look at when we are evaluating a startup, right? The first is the team, and what is the quality of the team, right? And how do you, project complementary teams? So the two or three things here is what is the pedigree of the team, whether they've been working together in the past, are their skill sets complementary? And of course, if you're a single entrepreneur and you're Michael Phelps, as the graphic below determines, nothing like it, you'll get your investment. But more often than not, we're not all Michael Phelps, so we need to, perhaps be able to bring in. It's always better to have more than a single promoter to a company. Try and find somebody who's got complementary skill sets, and some demonstration of your power to execute is useful, right? When we look at team, that is what we are projecting from the team. We're going to look at whether you have the execution capability or not, and whether you have done that in the past, or what is it that demonstrates that. The second one is, or the second part of it that we would definitely look at is there some uniqueness that you have that sets you apart, right? Do you have either technology, do you have intellectual property of some sort, or is your business model differentiated, especially if you're playing in a segment where other players are already existing, right? There is always the opportunity for you to hit a white space and say, I'm going to service something which has not already been done in the past, but that is few and far in between, right? There's a saying that goes that it is the explorer who faces the bullet and falls down, but it is the settler who eventually goes and, settles down and takes takes the land, right? And entrepreneurship is similar, right? Very often the first guy who gets into the business is not the guy who ends up winning. He's the one who takes the bullets into a particular space, and then you have somebody else coming in and taking the space once the guys in front have found out all the challenges. Somebody learns by looking at others. And the classic example, I mean, in the big wide world that we all know is the Orkut versus Facebook. Orkut MySpace came in a few years before Facebook, but the one that has ended up dominating things now has been is Facebook very clearly, right? So somewhere, what is it that differentiates you in terms of either the market you're servicing, or the business model that you have, or the technology and intellectual property that you own, is something that we want to see as an ingredient to success, right? And it's not just about having the technology, right? You need to have that technology marketable. The new technology cannot be the baby with the test tube head, shaped head, right? It has to be the outcome of that technology, and novelty has to be something which the market will accept. And that is a little bit of forward-looking part that your investor will have to do and look at the risk associated with that. The third part, of course, nothing like this is if you can go to the investor and say, I've got traction, right? If you have customer validation, enough customers who are ready to pay a reasonable price point, which gives you sufficient margins, this is what is the piece that demonstrates to the investor that A, the team part of it is taken care of, the differentiating part of it is also largely taken care of. You've got customers who are willing to buy your product or service, right? And then the only question that will arise in the investor's mind is the scalability, therefore, of that traction, right? What size of market are you playing in, and what could possibly be the size of your play going forward, right? And this could also be through adjacent services. For example, the simple one here is somebody like Flipkart or even Paytm. Flipkart started off selling books online, right? Paytm started off being a mobile recharge type of offering. And both of them have moved into spaces which are far larger and far scalable, right? And some of this evolution has happened with the help of the investors who came in early enough to understand that true scale really is not necessarily in what exactly you're doing today, but in what you could do with what you have set up to do today, and how you could perhaps expand that to other areas which are adjacent and complementary, right? So nothing like traction if you can demonstrate it, and if you have the holding power before you go to investors to actually demonstrate some of that traction, either with proof of concepts with customers, or with even early sort of deal wins, if you may, with marquee customers, that is something that is very useful. And if you look at the cartoon at the right and the bottom, it's really to demonstrate that ultimately execution is important, right? You may have a great team, you may have technology, but you may still execute incorrectly. And if you can demonstrate that execution capability with some of the customers that you acquired, there is nothing like that. I'm just moving on to the next slide, Anju. We see economics.
Sure. I'm on that slide.
Yeah. So the other thing is, I mean, very often when I meet entrepreneurs, you have a little bit of, or I sense very often that there is a little bit of lack of understanding of how the investor has thought, or how the investors think, how venture capital funds think, right? And it is very often diametrically opposite to the way an entrepreneur thinks. The fundamental DNAs are sometimes slightly different, which is what very often leads to a disconnect, right? So you have to understand this very clearly. Entrepreneurs look at problems, look at the opportunities, and they see the size of the opportunities, and they look only at the opportunities very largely, right? What does the investor look at? He looks at risks, he looks at probabilities, and at what could perhaps go wrong, right? And I've seen many conversations where entrepreneurs spend 45 out of, let's say, 48 minutes talking about all the things that could go right, or what would happen to the business or startup if everything went right, and the investors, or we are often thinking in terms of all the things that could go wrong, and therefore discounting all of the successes because perhaps the entrepreneur has not thought through that. So I think this fundamental distinction between the two is something that we need to be careful of and wary of, and understand that there's two different thought processes that are involved here. And it always helps if the entrepreneur understands this about investors, right? Typically, what happens is that investors meet a lot of entrepreneurs, right? Every day we're meeting hundreds of, not hundreds every day, but over months, several entrepreneurs, and therefore investors get a sense, right, of how entrepreneurs think. And I think it's very useful if the entrepreneur can also get a sense of how investors think, and in terms of what are the risks, what could go wrong, and what could be mitigated at what stage in the entrepreneurial journey, right? The graph or the infograph at the bottom left, which talks about the venture capital funnel, is to really tell you, look at it. This is, I think, 2015 numbers in India, if I'm not mistaken. 1,027 seed stage deals, right? And if you look at the next round being Series A, and what is called here the third round being the Series B, only 23% of the companies have made it, right? And I'll give you an example. For example, everybody knows about cab aggregation and the Olas of the world today, right? Recently, very new, interesting trend and phenomena has emerged in the trucking space, very similar. Aggregation of trucks, both intercity as well as within cities. And this is a huge opportunity because the business, the size of the market, because the B2B type of opportunity is very high, and even higher comparable to the passenger segment, which an Ola perhaps is addressing. 3 or 4 startups have come into this space. And the 5th startup came to me and said, and all these 3, 4 have been funded, a couple of them by Flipkart, in fact, others by big names, angel investors who are marquee names that you would have all read about in the newspapers. And the 4th or 5th guy came to me and said, listen, we're trying to put up this trucking aggregator, and we have interest from somebody, an investor in the Gulf, right? And to me, and they were just looking for guidance on whether they should go ahead and what I thought about the whole thing. And to me, the point was, listen, it is not getting your seed stage funding only. When these other 4 or 5 guys are there, and if you are one amongst 5, all of you would have got seed stage funding. Not all of you is going to go on and get your Series A and finally your Series B, and a whole lot of other factors are going to play, right? It is not just the number of customers that you acquired. It's a multitude of factors that are important when investment decisions are made by funds. And therefore, you need to ask yourself, what is the probability that if you were the 5th guy, that you would go on to raise not just your Series A, but Series B, and be in that top 23% that gets that Series B, right? So there is a little bit of thought process as you set off to look at your competition and see where you will stand going ahead, and not just at this point of time, right? The other part that you should understand when you're approaching a venture capital fund is, the startup, a successful startup is like a perfect storm. There are perhaps 40 things that can go wrong, and even if one of those goes wrong, very often a startup fails, right? And every one of them often has to go right, or certain decisions have to be changed and flips made along the course of the startup's life before you have a truly successful startup. And I mean, when I talk about truly successful, I'm talking about companies like InMobi or, for example, Lalpath Labs, which recently had a fantastic IPO, right? And then you go back and look at, the VC has understood this. And what are the numbers that are going through his head when he's thinking about investing in a startup? And I've just put some basic numbers here. There's a lot more, things are a lot more complicated than this. But this is at a very basic level that, let's say there's a fund which has 100 rupees to invest in, 10 companies, right? That would be about 8 rupees each, because the balance amount goes to pay for the fees for the investment advisor or the fund managers, right? So let's say you've got 80 rupees left out of the 100 that you have as a fund size. You invest in 10 companies, 8 rupees each. Typical rates, you'll have 5 failures, you'll get your money back in 3, and you'll have 2 successes if you're lucky, right? You as a fund manager have a set of investors behind you as well, right? It's unlike an angel investor who's just taking money out of his pocket, right? And therefore, you're promised to those investors typically something like 25%, and you have a fund life of about 7 years, right? And if you do the math, therefore, to give this 25% at least, right, 25%, you've got a return 476 rupees out of that 80 rupees which you have invested, right? And if you split that between 2 successes, we're really talking about each success being valued at 452, right? Which, if you do the math, look at the multiple, which means that a company today that you invest in and the valuation that you determine is X, let's assume it's a 10 CR valuation, right? Within a reasonable time frame, you need to see that 10 CR valuation become a 250 CR valuation, and for you to be able to exit, right? And this is just to achieve the minimum promise to investors, which is 25%. You are definitely trying to look at a higher number than being, just returning to them 25%. So every startup that we look at as investors are startups that we believe will do 25x or more, right? And that is what you should be able to demonstrate in terms of your capability because of your team, your ability to execute, the market you're addressing, and the opportunity, right? And your plan has to show that you have the potential to scale significantly. I'm just moving on to the next slide, Anju, which is the investor pitch.
Sure. Yes, Mr. Raghavan,
So
we moved on to the next slide now.
Yeah, thanks. So I'm just talking about some of the key things which, are very basic, but often I find missing when startups pitch to me, right? And these are things that you must have come what may. There's a lot more that may go into your investor pitch, but these are the things that, are key. The first one, very importantly, is who are you? What do you do? And the ability to be able to crisply articulate that in a sentence, right? And if I were to talk about, let's say, for example, the India Innovation Fund, which I set up, and I had to talk about my reason for existence in one line, I'd say we are a seed to early stage venture capital fund, which invests in the ICT and life sciences sectors in innovative technology companies which have the ability to address global markets, right? That broadly covers a whole lot of questions that you might have about the fund. And similarly, the ability to be able to understand and articulate what your company does, who it services, in a very crisp fashion is important, right? The second part about it is your deep knowledge of the customer problem. What are the dynamics of the sector? And what are the friction points, where you could go wrong, where you'll find the challenges, right? And, in conversations, I've had conversations with good entrepreneurs and with not so good entrepreneurs. The difference I find is when I sit in a meeting, let's say for half an hour or even 45 minutes with a good entrepreneur, at the end of the day, I come out having learned something about the space in which he's operating, something new, right? And we have a broad, let's say, bird's eye view of many spaces because of the number of entrepreneurs we speak to, also because of our investment team. So we need to follow sectors very closely. But when the entrepreneur can tell you something beyond what you know and you come out feeling educated, then you know that he really knows what he's talking about, right? And therefore, how do you get to that level with the knowledge of your space and the dynamics? And very often it's something as small, for example, as if you're selling a medical device into a hospital, is that medical device going to reduce the requirement of a doctor? And how important is the doctor in the decision-making process? And is he going to therefore allow for this if he feels a little bit of threat to himself. So stuff like that, right? What are the dynamics? What are the politics? What are the challenges? Understanding the ins and outs, and that can only happen if you either worked in that space before or you've spoken to several people who have been in that, who are, a part of that space, right? So I always, whenever I speak at entrepreneur events, people ask, what is your suggestion, or the first thing you got to do, and I say, go out and talk to as many people as you can about your offering. Don't hold back. Hold back key information, but try and understand the dynamics of your space by talking to all the different parts of your business model, which comes to the next point, right? You need to understand who are the moving parts in your business model, right? Are you trying to sell with real estate developers where architects are a big influencer community? Are you trying to sell to hospitals where doctors are a big influencer community? What about the supply chain guy in the hospital? Is it distributed? Is it centralized? Are you trying to sell it to defense forces? If so, are you doing central procurement? Are you doing procurement at states, at cities? Who are the decision makers, and who are the ones that influence the decision to buy your product is something that you need to understand very well as what are the challenges in your business model and what are the moving parts, right? At the end of the day, an entrepreneur's battle is very often you will be playing in a space where there is some big guy who is already established, and therefore you become a David versus Goliath type of battle. It is impossible to win against a Goliath being a David if you only have a 10% advantage, right? Because that guy's got a big brand name, he's established, he's been around for years. Winning business off him is tough. And therefore that incremental advantage I have seen in most cases needs to be upward of 30% before you can have a solid value proposition against an established brand. So try and figure out what the differentiation is, how you can deliver better. And I'm glad to say that I've had technology companies in my portfolio who've beaten, for example, the likes of IBM, HP, international tech companies when they're sold to large marquee clients in India. So the good news is there are a bunch of people or a bunch of Davids who have succeeded. The question is, how do you strengthen yourself, or what you can do in terms of differentiation to make it sufficient for you to become really attractive to a customer. The other thing that you need to finally understand is that VCs are looking at returns, right? I mean, you may look to change the world as an entrepreneur, and we also had a mission with the India Innovation Fund, which was to promote product-type companies out of India. But at the end of the day, all of this is successful only if there are returns made, and if there is value which is built into the company, and the company's value really grows. And to do all of that, you have to identify who is the customer who will pay you. You could very often, there are several cases where you will have multiple customer segments, and you would have to end up ensuring that the one that is in the best position to actually pay you is the one that pays. And often your services will be, or one part of your services get offered as a free sort of service to another part of your customer segment, right? Anju, I'm just moving to the next slide, which is the common mistakes in the investor pitch.
Yes.
Yeah, so this is just, thanks. So this is just taking off from the earlier slide and some experiences that I've had when talking to entrepreneurs in terms of errors that are made in their pitch, right? And the biggest one that I found in terms of the number of entrepreneurs who make this is a little bit of a poor competitor analysis, right? And sometimes the entrepreneur gets lucky because he's talking to a fund or an investor who is not aware of a particular space and everybody who exists. But remember, we go back and we do our homework after that as well. Very often, there might be an understanding of that space. The investor may have an understanding, and it looks really bad when you're not able to demonstrate that you've done your homework well enough to actually identify who your competitors are. The second part of it is don't compare apples to oranges, right? And when I say that, I had, for example, eventually this gentleman became part of my portfolio, but a pitch in terms of an analytics offering which was personalized analytics, right? And personalization is something which is a more recent phenomenon. But he was still comparing himself to the SaaS of the old days. His whole pitch was how he's better than SaaS or how he's better than legacy system, right? And not comparing himself to 4 other offerings which are there today, which are in the personalization space, right? I think it's very important to understand that industry or in the offerings have moved, and you really need to do a like for like or apples for apples comparison as to who your competitors are, specifically in what you're doing, and not compare yourself to something which is which has existed in prehistoric times, right, or earlier. And a simple example I would say is, comparing and a mistake could even be an Ola comparing itself with with the auto rickshaws and saying that yes, these guys are competition. Fair enough, they are to an extent, right? But enough people had come into the space in terms of cab sharing, right? And I'm sorry, not cab sharing, but into the cab service space. And even a comparison by Ola with somebody like Avis, which was doing more of corporate and booking and that sort of thing, would have been an incorrect, not like-for-like comparison, especially when they had competition, which was more of the radio cab variety around when they came. Right, so I think the key thing is to really be able to call out who your competition is based on your specific offering, right, and to understand the entire landscape of who is there and who could be a threat. The second part I've seen a lot of is that a good product is not always a good business, right? Very often tech entrepreneurs, fantastic technology guys, come out with unbelievably good ideas and so creative that, sometimes a pleasure just to meet them. But what they fail to understand very often is that just because you have a good product, it doesn't mean that your business will be the best. If you have the best product, it doesn't mean you have the best business. And I'll give you a little bit of a story here, right? This is about 3 or 4 years back, and 2 companies, I'm not going to name, they're both well known, right? Both of them were in the ophthalmology device space, right? So ophthalmology is related to the eye, and both these guys were building portable devices for ophthalmology. And the first entrepreneur came and met me, very sharp guy, studied at a top university in the US as an engineer, came back, had got together with a top-notch design guy in India, and they had created this entrepreneurial effort. And they were telling me about this device. And I said, listen, what's the story? What are you going to do with this device? And they described the whole thing, very impressive device. And they said, at the end of the day, we're going to be selling these to hospitals. We've spoken to ABCD, big hospital, and they love it and they want to buy it. Exactly a week later, another startup came to me, and these were the 2 founders, both of whom had been very senior executives in a multinational in India, and they'd worked together. Exactly the same device, right? And as they were talking about it, I felt a little smart because I'd already heard the other entrepreneurs, so I could answer more relevant questions. And at the end of it, I tried to sort of say, hey, so you are going to sell those to hospitals as well, aren't you? And they said, no, that's not what we're going to do. We have a much larger vision. Selling to hospitals would be the easiest thing. What we're trying to do is to get into, a services-driven model where we can set up point-of-care centers all over, including Tier 2, Tier 3 cities, and then use this as a device for screening and recommend patients to hospitals wherever required. But we will set up the infrastructure or work with people who have infrastructure to actually go out there and deliver a point-of-care service, right? And to me, the size of what these guys are describing, or the magnitude, suddenly seems so much larger than that simple sales to hospitals, right? What happened eventually, these guys got funded by the 2 top VC funds in the medical space in India. They got a 5 million round immediately and went on to get about 100 crores after that from another very large Asian-based VC fund. The other guy got maybe $1 million, I think, in grant money, and only perhaps a month or 2 months back actually got a moderate size of, perhaps I can call it an angel round, where a network of angels got together, right? So you can see the difference, the vision that your company and the size and the magnitude and how you approach business with the same product could be worlds apart, and that could lead to this very different type of investment decisions that are made by funds. Just moving quickly through the other points, I think it's important that revenue model, and I spoke about this in the last slide, who pays, how much, what is the type of revenue model, are you licensing, are you getting a commission, are you making an outright sale, which of these works best? And typically VCs always like annuity models. Rather than making a single sale, can you somehow put out that sale to the customer and then have him buy more and more or upgrade more and more over a period of time so that he becomes an annuity customer, right? And this is simple logic. The cost of acquisition of the customer comes down because his lifetime value goes up. And once you've acquired the customer, you're actually getting more of a lifetime value out of him, right? So VCs like annuity type models, and I think in many cases it is possible to change a single sale model to an annuity model with a little bit of innovation. The other thing is obviously scale, right? Are you going to scale, and what sort of size of markets will you hit? The other sort of the sentence that I've heard very often is, hey, here's a huge market, right? And we only need to get 10% of this huge 10 billion market, type of comment coming from entrepreneurs. And this is a very generalization. Anybody can say this, right? What is important to talk about is not just it about being about getting 10% of a 10 billion market, but how you're going to make a difference and what is going to be differentiated in your product out there, right? And then the VC will figure out whether you'll reach 10% or whether you'll reach 5% or 1% or what is enough. But can you clearly articulate why you will get out there and service more and more customers than somebody else who's already in the market or who may also enter after you, right? He's unable to do so. And I think that is more important. The second way to perhaps demonstrate your growth is not to put a number out there in vacuum and say that, oh, I'll get to 10% in 2 years of the market share, but to look instead at arriving at a proxy. Try and find other businesses which have been close to yours, right? And what sort of growth that they have done, what sort of market shares perhaps they have achieved, or what sort of acquisition costs that they have undergone, and then correct it, either upwards or downwards, depending on whether your model is more efficient or a little bit more capital intensive, right? So I think using proxies in terms of something that has already been there is something that goes down well with venture capital funds and with investors, right? The other thing is just avoid hyperboles. I think you understand that big grandstanding statements, yeah, I will win, I will become a big unicorn in 5 years, blah, 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 all of that, right? Best avoided. Humility typically comes across very well. Ambition with humility is what is the right mix if you can demonstrate, right? And you must understand when you get into a VC conversation that sometimes the VC is going to test you as to how you will react as an entrepreneur. Remember, when an investor invests in you, it's going to be, and some people talk of it like marriage and all that, I'm not too sure, but you're going to at least spend several days in the month with the VC. You're going to be a call away from him. He's going to be a call away from you. You're going to have several discussions. You're going to agree. You're going to disagree. There's all sorts of dynamics that are going to play out, right? And that happens normally after the investment. But when an entrepreneur approaches the investor, it's normally everybody's at their best behavior, both the investor as well as the entrepreneur, right? And sometimes clever VCs would stress test, if I can call it that, use a technology term, the entrepreneur by challenging him, right? And the more an investor challenges you, I think, rather than taking it personally, it's important to be able to come across as being able to address his questions in a manner that you have thought them through. And if, for example, there is a point that he has which you think is valuable to you, you perhaps point out that it is value, right? And it is of value, and it is something that you might think through as well. I'm just moving on, Anju, to the next slide, which is finding the right investor for you.
Sure.
So there's there's two things, right? I mean, these are last two slides I have, in case people are becoming impatient. But I spoke about success breeding success, right? And winning is a habit as something which is very important to think through. And at the same time, you have the spray and pray type of approach, right? I personally think that if you go to an investor, you should come out without, having too many bullet holes shot for you. And the reason is that every no does erode confidence of the entrepreneur, right? So making a good pitch to the right investor is important. It may not lead to an investment decision or a positive investment decision, but it will at least lead to a great exchange of ideas, and then the investor may say, hey, I'm not able to support you because A, B, C, D, E, or this is what we are looking at this point, right? And therefore, I would be very careful. Rather than a pray and pray type attitude, I would rather be very careful as to which investor I approach. So how do I determine that? The best way, of course, is if it's incoming. If your investor comes to you, right? It happens rarely. I have done it once where I have approached an entrepreneur and then he said, hey, I don't need your money. Fortunately, he called me back 2 months later and said, listen, now we need your money. And he is one of our success stories out of the India Innovation Fund, right? So nothing like having incoming investors. There have been examples of that happening. There's a company called Postman. We should look it up in the API space. They had 3 investors approach them because of the quality of work that they were doing, right? Rather than the other way around. But that doesn't happen with everybody. So how do you figure out which investor to approach, right? And that's where I say that first look at, every investor has got a website, right? And normally emails are there as well, where you talk to the investor. You can approach different people in the investment team. And I think that you need to first go to the portfolio page, understand the portfolio of every fund, understand which stage they invest in, understand the sectors they invest in, and understand teams that have worked well for them, right? So let me give you an example of a team. Aggregation, for example, is a team, right? And if you look at my point 4, it is, capitalized and large and bold and all of that, because this is so important in the psyche of an investor. Any investor who has invested in a particular team and found success will look for other investments in that team because he's had a positive experience, right? And let me give you an example here. Inventors invested in Redbus, one of the early investors in Redbus. And to them, Redbus was the aggregation team, one of the early aggregating buses all over and, customers on the other side. And therefore, if you went to Inventors and used the word aggregation, it always sounded fantastic for them, right? And on the other hand, I know of funds which have invested in the medical device space, selling into India, right? And the Indian market is not ready for medical devices yet, right? Or innovative medical devices. It's still a global play. And they burnt their fingers. And if you therefore went to them and said, hey, listen, medical device, the guys are going to say, no way, not going to touch this, right? So be careful to understand what the success is, what is the success of this fund that you're looking at, who are the successes, and therefore out of that, what are the teams that make sense for them. The other thing that you can look at when you look at the fund's portfolio is, are you going to be able to service one of their portfolio companies, right? Let me give you an example. If you were to go to Axel, one of their portfolio companies is Flipkart, all of you know that, right? Would your offering be of value to Flipkart in any way? Let's say you're an analytics play, right? Would it be or a logistics play? So the easiest thing for them to do is to connect you with their portfolio company and say, hey guys, you tried this out, right? And then the investment decision is based on the feedback of their other portfolio companies. So customer feedback is so important. And if those customers are in your own portfolio, obviously you feel that, hey, I can A, get feedback, but B, if I invest in these guys, I can very quickly connect them to multiple customers and therefore be able to add value very early in the, in the investment cycle. So these are some of the things that you consider, which comes to the point on what is the value add that your investor can get, right? If the investor thinks that he cannot provide value beyond the capital, chances are at the early stage he will say no. But if he's got the right customer connect, or if he thinks he knows, let's say, consumer internet very well or mobile very well, and he can really help you scale up or build your team through experiences that he's had in the past, then he's going to, like your idea or your startup venture a lot more than otherwise. Finally, when you meet and a lot of funds, even through their website, you can get a sense of their character. But obviously, much better when you meet with them, just get a sense of what are your comfort levels, right? Do you feel comfortable with that guy working with you pretty much as you would, let's say, make a marriage decision, or if you're choosing a partner for your business? And very important to evaluate that there have been so many issues with people who have perhaps sensed discomfort, but they have, let's say, quote unquote, in the interest of the company and getting in that large investment, have ignored this. And at the end of the day, 2-3 years later, there have been a lot of, sharp breakups. So it's important to understand whether you have, you feel the personable with your investor, right? Just moving on to the last slide, Anju, which is approaching the investor.
Sure.
So finally, how do you get to the investor? You've decided all this. You've decided how much money you want. You think your company is right for an investment. What is it that you do? When do you approach the investor? How? And nothing like the network effect. And if you can, investors feel so much more comfortable if somebody that they know is talking to them for the first time, somebody who is believable, right? So try and expand your networks. Do that well before you need to approach the investor. Like I said, keep talking to people, and you don't know who's going to, succeed. Who's going to point you out to somebody, right? I'll give you an example for these guys. Aavishkaar Energy, which has just launched their electric scooter, well-funded company, came and met me at, this is a couple of years back, year and a half back, to say, hey, we're looking for an investment, etc., etc. And I was talking to the guy, still not built his scooter, nowhere near it. We spoke for a while, and he said, next week I'm going and meeting Sachin Bansal. I somehow got an introduction because of the IIT Connect, blah, blah, blah. And I'm going to try and pitch to him that I want to sell my scooter on his website, right? So launch it pretty much like a Xiaomi launch. Can I launch my bike on the electric, on Flipkart? And he went and met him apparently, and Sachin said, listen, I'm not interested in, I don't think we can launch you on our site, or I don't know, you've not even built the bike, so let's figure that out later. But I really like what you're doing, and can I make an investment, right? And he went to talk about something else. He got an investment, $1 million or so. And 6 months later, Tiger Global, which was Sachin's investor in Flipkart, wanted to look at what the other companies that Sachin had himself personally invested in to see if they could invest in that. They looked at this company and they said, fantastic, we want to invest. And I think they invested about 100 crore or so within 6 months of Sachin's investment. So sometimes networks, making some of these calls, and talking to people helps more than you can believe it would, right? The second part of it is, I've not been a fan of the elevator pitch. Everybody goes on and on about an elevator pitch, right? But if I'm an investor, I would like to really discuss at length with an entrepreneur, even in the first meeting, just to understand what he's about and what his offering is about well, right? So I'm not a fan of that 2-minute elevator pitch, but I'm a real fan of this 5-point email. Can you, when you first write to your investor and say, hey, I want to meet you, or a potential investor, how do you articulate your current state of business, your current, let's say, team, etc., the offering, and your potential, and the sort of vision that you have for the company very crisply and very precisely. Remember, you're one out of hundreds of emails, so the 5-point email, maybe 6 or 7 points, but extremely crisp, extremely precise, and defining what you do very clearly is very important, right? A lot of entrepreneurs have this question for me, and and therefore the investment bank question, right, which is the next bullet point, still has a whole lot of questions after it as far as I'm concerned, right? So do you use an investment bank to approach investors or not? And the answer I would have for you is this. A, how strong are your connects with investors? Do you have, or have you tried to reach all the investors in your network through your connections? If you have, then perhaps you should, and you haven't managed to raise and you want to reach other investors, perhaps you think of an investment bank. The second part is, how well do you understand that you can, or is there somebody in your network, either an advisor or a mentor, who can really bring out your story by being a sounding board to you and say, hey, this is the story that will sound right for the investor, right, and brainstorm with you. If you have that, you can perhaps create your investor pitch deck on your own because you have somebody to guide you through the story. And I would always recommend an advisor or somebody you bring on your board, but in case that is not available for you and you are a little uncertain as to whether your story will fly and whether it needs, and if you want it refined, then my suggestion is that you actually use an investment bank to help you be able to do that, and select wisely there as well, right? Finally, how much of your idea do you expose? And I think by and large, if you cannot put out 90% of your idea, you cannot even begin to start telling the investor what you're trying to do, right? You may reserve 10% because you don't want competition getting word of what you're trying to do too early. But don't be wary. Finally, execution is the key. It's not the idea, right? Everybody's got ideas, but for somebody to take it and execute on it is going to be tough. What I would be a little bit careful about is I would be careful about sending an investor pitch or a investor deck to multiple people, right? And, then investors get this impression that you approached, hundreds of other investors, right? And we talk, it's a small community, we talk and say, hey, have you looked at this? Or has some other partner in my fund seen this? People forward PPTs very easily, right? So just be careful that you send a full, maybe teasers are okay, but a full-fledged PPT. Just be careful with who you share it with and make sure it isn't just, it isn't going through the system and the emails of 150 guys, of which only 15 are truly serious investors and the rest are just trying to, make a quick buck. So I would be a little bit wary of that. Otherwise, I think you should be happy putting your idea out. Yeah. Okay, so thanks. That's it from me in terms of the presentation, and hope this was educative and happy to take any questions.
Thank you so much, Mr. Raghuram. So for the presentation, so we will be going ahead with the questions now. We've got a couple of questions from the entrepreneurs. The first question is by Ankit Majetia. He says, on slide 4, when you talked about the entrepreneur that he should be confident or able to raise the series B or C, is it really necessary or compulsory to raise a second or third round? Isn't it possible that you raise series A and if the business model is good and profitable, it can self-sustain without raising further?
So here's the quick answer to that, right? And this is the reason I put it in the slide on inside a VC's head, right? Getting inside a head. Let's assume I'm an investor in Series A. Where do I exit, right? If your acquisition of your IPO is 5 years down the line, fantastic. If it's 15 years down the line, the unfortunate part is my fund life is only 7 years. What do I do to get that exit? Is something I'm looking for as an investor, right? So this is from the investor standpoint. If you can manage from Series A all the way to an exit through an acquisition or a buyback or an IPO, which I think are the 3 possible, exit avenues, or a secondary exit to another fund, right? But unlikely to happen. These are rarer instances where it can happen. If your business model and if you have such a fantastic business, I'd say go for it. However, the other question is this, that you must ask yourself even as an entrepreneur, not looking at it as an investor. Is there something that you can do by raising your Series B? Is there something that might take you a little bit longer, that you can do a little bit quicker, where you were you to raise some more capital and deploy more people out there or invest in something? And if the answer to that is yes, that you can accelerate something, right, then I would say that you should seriously consider going about it just in the interest of scaling the business up fairly rapidly, right? You have two choices. I tell every entrepreneur who meets me upfront, right? You have a choice at the beginning of life of the life of your startup. Either A, you decide to be, fairly conservative sort of lifestyle business, right? Or you choose to be a venture-backed, investor-driven business, right? Both are choices. Nothing is good, nothing is bad, right? But you're either choosing this A or B, right? And the speed or velocity at which B goes, which is the investor-led business, is higher, right? Because VCs have to give show returns. They have to do it within a finite time frame. And they're looking for entrepreneurs who are with them on that journey, right? And as a result, be honest to yourself, be honest to the VC when you talk to him and say, hey, if this is my road to success, it could be Series A moving to a Series B or C, or it could be Series A moving to an M&A, right? But you have to demonstrate the exit potential for the investor.
Thank you, Mr. Raguraman. Moving on to the next question by Raki Mehra. She says, hi, I am into e-commerce with the niche customized products started in April 2014 and generating revenue of 1.8 crore with profitability. Now looking for expansion in terms of opening a couple of physical stores across India. Already running 2 physical stores in different cities. When should I approach investors and how?
Okay, that's a very good question, right? And a lot of people dabble in this online plus offline model, right? I have seldom seen it work, but there are cases. For example, I know that Lenskart started moving out from a purely online business to making to having presence on the ground, because they realized that when they're selling eyewear, that testing is a very important criteria, and that patients want to have themselves tested when they're ordering and blah blah, right? So as a result, the combined model does work. Otherwise, if you are not in a space which necessarily needs an online plus an offline presence, and I was talking to somebody who was building, for example, this was a couple of months back, building fashion wear for fashion wear for pregnant women, and she was doing it primarily online. They're saying now we want to set up stores, right? Setting up stores is not necessarily the best way to go in terms of the capital intensity that it provides, and investors typically realize that unit economics at store level need to be proven before they would do it, right? Therefore, the suggestion to her, in her case, because she was setting up a fashion and she had a fashion portal, was to set up a concept-like store, right? Maybe one in a city or two a city, but not use that as a real retail store, right? And so that was the second way that that was the second sort of point in this particular question. The third thing is, finally, if you are saying, hey, no, it does make sense for me to do online as well as offline, right, and have stores, I think there are two things that the investor is going to look at. The investor is going to look at, listen, is your online going to be the future of your sales growth, or is it going to be offline, right? If it was online, the typical online metrics in terms of how many customers you're acquiring, at what cost you're acquiring, and what is the growth over there is going to come into question. If it is a predominantly offline model that is going to become the future, most investors would look at, have you established in these one or two experiences that you have already put out, have you established unit economics which are profitable, right? So you may be profitable on your 1.8 CR as a company, but is every store that you're putting out profitable? Have you understood your store location criteria well? Have you understood your customers well in retail format? Have you understood that business model well, right? And if you have with these two, and if you are showing unit economics which are showing decent margins, then there is no reason investors will not invest in you even now, and you can approach them. If not, if, for example, you need to cut costs, you need to increase sales to a point where you're profitable or where your unit economics at the store level are fine, then you would perhaps be better off waiting it out till you have demonstrated that and then approaching the investor.
Thank you, Mr. Raghuram. Moving on to the next question by Shiju Krishnan. He asks, what is the ratio proposition in general while we give the stake?
Sorry, can you repeat the question? I didn't quite hear it.
Sure. He's asking what is the ratio proposition in general while we give stake to the investors is what he's saying, VCs.
What is the ratio proposition?
Yeah.
Okay, so I think that there's a lot more that goes into it. It's a very complex mechanism of how we arrive at stakes, right? And how much it really depends on where your business is, etc., etc. There are 2 or 3 key aspects, right? Let me at least point out what are the 2 or 3 key aspects. You need to find out who are the comparable companies which are similar to you, right? What are the closest proxies to you who have already got an investment? And they would have raised investment at a certain multiple of their revenues, either one year forward-looking revenues or their existing revenue, right? And that multiple normally comes into play, right? So that multiple is taken, it's sort of averaged out between 2, 3 such other efforts, and it is applied to your revenues, either your historical revenues or to your forward-looking revenues, right? However, there are several cases where investments are made where revenues are still too early for you to actually apply a multiple, right? So somebody who's making, let's say, 15 lakhs or 20 lakhs and is trying to raise 2, 3 crores or a small number, right? In which case, you are going to have to look at many other means of actually figuring out how much stakes you want, right? As an investor, you're going to look at how much returns you want. You're going to look at, let's say, assume you are going to exit in 5 years. What is the value of the company going to be? How much you would have diluted because of rounds that may happen in between, right? And then you will take a call that, okay, this makes sense at this value. This is what is the numbers, right? Investors like us, right, India Innovation Fund, investing in innovative technology companies, sometimes close to zero revenue, sometimes in markets which have not even been penetrated. How do we even have a proxy? How do we even understand, right? And we follow thumb rules very often. We have a sense of, we look at the team, we look at the opportunity, we look at the technology, what is the IP. And based on it, we use, it's more of a thumb rule focused mechanism of arriving at a valuation, right? So there's no real answer. And finally, I think the last point I want to make is if you go to a Series A investor or Series A or a Series B investor, typically they will want to eventually reach between Series A and B about 30 to 35%, right? And they will value the company accordingly, right? Normally, you will not find Series A or Series B investors wanting to come in at 10 or 15%. They will generally look for something around 30%, right? And therefore, they then back calculate, given that they have a range of how much they can invest, are they going to make a 5 million investment to get that 30 or an 8 million investment? And that is, based on how well your company has progressed and what its, existing metrics are.
Thank you, Mr. Raghuram. Moving on to, we'll just take 2 more questions. This is the second last question by Vijay Ayyappan. He asks, can you tell us merit and demerit on convertible preferred stocks? Can promoters subscribe to CFS for eligible bonuses or as incentives?
Sorry, can you repeat that again?
Sure. Can you tell us merit and demerit on convertible preferred stocks? Can promoters subscribe to CFS for eligible bonuses or as incentives?
Convertible preference?
Preferred stocks,
I'm not sure whether they're talking about liquidity preference or is there some way you can clarify this question?
He must be listening to us, so I don't know. Well, okay, so we'll take up the next question, and by the time if he types in...
Could we take the next question and could you clarify this question? I just want to understand which clause it is in, because there's promoters involved as well. and normally promoters don't get convertible clause. But perhaps you could clarify the question so that, and we can take the next question in the meantime.
Sure. Okay. So moving on to the next question from Sambhav Karnawat. He says, he's a founder of Jewel Love, a bootstrap startup. We have positive unit economics growing fast. I'm looking for growth capital, but when I approached some analysts, they actually said you don't need us. But I know why and where exactly I need the investors' support. I mean, he wants to know why and where.
Okay.
No, okay. How do I approach to get this past the analyst?
Yeah, that's a good one, right? So it goes back to my point earlier on you're having a hit a dead end by not hitting the right guy in the fund, right? Normally, if you are not able to get past the analyst, it is unlikely that you will get to a partner in any case, right? But I would do two things. First is obviously go to another fund or other funds. You don't need to necessarily go to the single fund. And if every analyst is telling you something, then there must be some amount of truth to what is being said, right? But if, for example, you think that there is a particular analyst who perhaps doesn't like what you're doing and is being a hurdle, I think leveraging networks to get to a principal level person is very useful, right? And therefore, how do you find a principal or a partner, and what is the way to reach him? Through your networks, and perhaps even get into some sort of informal conversations with them, right? So there's somebody in your network who may know them reasonably well and just have an informal chat, right? And see whether they would be interested in this, proposition or not, right? And I haven't heard, or I cannot imagine an investor coming and an analyst coming and telling you, listen, you don't need our money, right? Normally the answers are, listen, we don't find you interesting enough, or you don't fit in with what we're doing, or you need to go back and, build a little bit more and come back to us. Or if we can't add value to you, think of some other investor, right? But rarely will you say, hey, you don't need the money, right? And investors are, in fact, looking for opportunities where the entrepreneur actually doesn't need the money, right? It's ironical, but believe you me, when you really don't need the money is the right time you should go to a fund, right? Because that's when you can really discuss value and get a good value out of the whole discussion. So I would say try and go around this particular, gentleman or woman by leveraging your networks and trying to hit somebody who's at a principal level by going through the firm, finding out who is part of that firm, and then moving around in the entrepreneur community. For example, one very good way is to try and interact with the portfolio companies, founders of portfolio companies of a particular fund, and introductions that are made by the founders of the portfolio companies to a fund manager are often, treated with a lot of value, right? So can you get to somebody else in that portfolio? Maybe one of them could be your customers, right? So could you have a conversation, and if you have established a relationship, then you can actually be able to, eventually ask the founder of the other company to give you an introduction to his investor. It will also, it's also useful because when somebody is a founder of a portfolio company which is part of a fund, he will know which partner or which principal is the best to approach at what stage, who is the challenging guy. He's sort of got a sense of the dynamics of that fund by then, right? And he'll be in a good position to guide you.
Thank you, Mr. Raghuraman. Now, Vijay has clarified his question. He says, what are the type of instruments VC prefer for investing into a company? Is convertible preferred stocks as one such option?
Yeah, so there are 2-3 instruments, right? One is something called CCPS, which is compulsorily convertible preference share. The second is something called OCPS, optionally convertible preference share. And then there's a third instrument which is called OCD, right, which is optionally convertible debt. Most of the private investors in India, because they have background which is outside of India, right? So you take the Accel, the Nexuses, the Matrix, all these guys have Prince Helion. Predominantly, they have a parent who is sitting in the US or some other part of the world, right? and most of them set up their investment vehicles into India out of Mauritius or some third country, right? Now, because of RBI regulation, all of these guys can typically only do or invest using the CCPS instrument, which is the compulsory convertible, right? They cannot optionally convert. Domestic funds, on the other hand, can use, and CCPS, let me tell you, is the most friendly instrument to the entrepreneur because the investor is forced to compulsorily convert his preference shares into equity at a certain predefined, event. In the case of OCPS, it is optionally convertible. So the guy may retain it as debt, right? Or as an optionally convertible share. And even when equity is, or even let's say, for example, in the case of a liquidation event, he may not convert to equity and he may keep it as a preference share. Not the best mechanism for the entrepreneur, but in the case of some domestic funds and ourselves included, I have used the OCPS on some occasions where I felt it would be useful. Right. The third is something called OCD, which is optionally convertible debt. So either it stays as debt or it is converted to equity, and that option is at the hands of the investors. Right. Very few funds use this. I think there's one or two funds in India which are primarily government type funds, right, or quasi-government funds which use this instrument. And if you come across them and if you have to have them invest in you, then you should understand that, listen, this is their process. They stick to this. This is the way they work, right? And there is no harm in going ahead with it. But you would rarely find a private or a foreign fund which comes and tells you that you should use OCD, right? What you should be looking at when these instruments are used is what is the liquidation preference. There's a number called liquidation, or there's a phrase called liquidation preference, right? And in some cases, a friendly investor will say that is 1x, and other investors will give you a multiple, either 1.5x or 2 or 2.5 or whatever, right? Normally the range is between 1 and 2.5. I think that's a topic which is large, so I won't go into explaining it. Perhaps you can read up about it, right, to understand, why and when preference shares are used and what is liquidation preference. These go hand in hand when investors are using an instrument to invest in the stock.
Thank you. Thank you so much, Mr. Raguraman. So that was the last question, and thank you so much for that interesting session, and thank you to all our attendees for participating in the webinar. We are glad that the questions kept coming in, but due to lack of time, we are unable to answer all. If you found the session interesting, please feel free to blog or post about it. The recorded version of the webinar will be available on YouTube. Thank you once again, and have a nice evening. Thank you, Mr. Raguraman. Thank you so much.
Yeah, thank you, everybody.